right, this is my super low budget Gen Z idiots investing guide for people that have no idea where to start, no idea what to do. And this is going to cover how to not fuck up and blow up all your money. So now we're going to get into why invest. I think that's one of the most important questions to tackle because you're not going to have any motivation to invest if you don't realize how valuable it is. Click onto this link. So this is an investment calculator, right? So let's say that you have $0 and you invest for 30 years at a 10% return, and you invest, let's go $200 a month, right? That's $415,000 only investing $200 a month, right? That's not a ridiculous amount of money. You would have contributed $72,000 and you'd be earning, $343,000. So now if we go right here, what is the average retirement or average amount individuals retire with in America? Right? So if you look right here, it says the average is 609,000. But I know it's been a long time since math class. You never want to look at the average because that's heavily skewed by ultra wealthy individuals. Median is what like the middle selection is, and the median is the true average. The median is $200,000 to $300,000. So all you need to do right here is put $200 every month away, and you will have double what other people retire with, right? And realistically, this is not very much to retire with. You want a lot more than this. But all I'm saying is all you need is $200 a month for 30 years, and you can have double what people retire with, right? And if you're making 3, 4, 5K a month, for you to put $200 away just means canceling a couple of subscriptions and maybe eating out a little bit less. It's not the hardest thing in the world. And if you start, let's say, at 20 and you want to retire, actually, let's go 39. Let's say you start at 20 and you want to retire at 59, right? Look at what this number changes to. If you start at 20, you have $1 million. Boom. $200 a month, that's all you got to do, right? If you're a parent and you have your kids start, say, at 16, add another 4 years to this. So 43 years, right? They have $1.5 million. So having good parents is pretty important, right? If you can start earlier, the better through a custodial account. All I'm trying to show with this is that even if you don't have that much money, you can still retire with a reasonable amount in addition to any pension, social security, disability that you might be able to receive through other means. Now, let's say that you put a lot more in. Let's say you put, I say that's kind of unrealistic for most people. Let's go $500 a month, right? A lot of people are able to get to that. And let's say 30 years again, and you start with $0, but you're doing $500 a month, 30 years. Let's say you start at 25 years of age, right? So you would want to retire at 55. You could have $1 million, right? That's real good. Now we can go, let's say you start at 20 years of age and you want to retire at 65. So that would give you 45 years of compounding. You would have $4.5 million. Let's reduce that. Let's say you start at 25 and then you want to retire at 60. So that would mean 35 years of compounding. So at 25, retiring at 60, you would have almost $2 million with $500 a month, right? So this means that not only is it possible to retire early, but on top of that, you don't even need to be putting thousands of dollars away a month. You just need to be consistent with averaging about $500 a month, and you too can retire at 60 years of age with $1.7 million. Next, we're going to get into where to invest. People say, oh, invest, but no one really talks about where to go. These are the two options that I have selected as what I consider to be the best. On the left, we have Robinhood. Robinhood is my preferred choice for retirement accounts. If you go to Robinhood, they have a 3% match on Roth IRAs, meaning if you open a Roth IRA with them and you put in $1,000, they will match $30 of that and put that directly into your account. This is really good because if your company has a 401k match or your company has some type of retirement system, you can take advantage of that and take advantage of this through Robinhood. I will leave a link in the description that you can click on, and you would get like between, I think, a $5 at the minimum stock in your account when you open an account with them. Fidelity is the other option. I use Fidelity for my taxable brokerage account. So I have accounts on both of these platforms. Fidelity doesn't offer any type of match, but they have a very clean website to look at. And they were the brokerage that I initially started on. And I just think they have an excellent reputation. And I would like to diversify my retirement accounts versus my personal brokerage account, which is why I use both platforms. And it's something I also recommend you do. Next, what to prioritize. Say you have an account on Fidelity, you have an account on Robinhood, you open those, but now where do you put your money? The two accounts that I believe are to be the most important are your Roth IRA on the left and your brokerage account on the right. The Roth IRA is an account that you put money in after it's already been taxed. If the government takes $300 out of your check, right, you have $700 left. Whatever money you put into your Roth IRA has to be out of that $700, right? It's going to be after the government's taken their cut. But then when you withdraw from your Roth IRA, you pay zero taxes. So right now I have $20,000 in my Roth IRA. If I go right here, say I have $20,000, right? Let's say that I access this at 59, which is the earliest I can access it. I'm 21 years old right now. So that would mean, man, I'm math's trash right now. So 21 is, let's just go 38 years, right? So I will be 59 in 38 years at a 10% return, and I don't add any more dollars in here. I'm just going to leave that 20K. I will have $748,000 in my Roth IRA at 59 years of age after adding no more dollars to it, right? But normally in other accounts, when you try to withdraw this money, the government's going to tax you. You're going to have to pay capital gains tax by selling your stocks to use this money. If you have a Roth IRA, however, because the government has already taxed the money beforehand, you can withdraw all of this money tax-free. Right? So that is really important because not only can you take advantage of the Robinhood 3% match, but you also can withdraw that money tax-free. And that also means you can do trades, right? You can sell and buy stocks within your Roth IRA and pay no tax, right? Which is something that you don't get to do in the brokerage account. Then you might say, all right, why even have a brokerage account, right? If the Roth IRA is so good, what is the point of having a brokerage account? The thing is, because the Roth IRA is so good, the government puts a limit on it. You can only put $7,500 per year into your Roth IRA. So if you're someone like me who's trying to invest more than that, you need somewhere else for that money to go. Additionally, you can only access your Roth IRA penalty-free after 59 and a half. So say if I want to retire in my late 20s, 30s, or 40s, I will be paying a penalty on my Roth IRA to withdraw that money. You can withdraw your contributions with no penalty. So I personally, in my Roth IRA, this year I've added $5,500, and then last year I had added $9,500. So I personally added $15,000 to my Roth IRA of personal contributions. So I can withdraw those with no penalty, but beyond that, anything else I withdraw will have a penalty. So a Roth IRA is a great way to park your money when you intend on using that for retirement after 59. But if you want to retire before that, you need to have a brokerage account to fund your lifestyle up till that point. The brokerage account is a taxable account, meaning you have to put your after-tax dollars, so whatever you get after the government takes their cut, you have to put those dollars in, but they also tax you on your gains, right? And I'm going to give an example of that real quick. So we head over to my portfolio, And let's look at one of my biggest positions, which is AMD. As you can see here, I have made or have a gain of $3,000 in AMD. So if I was to sell my AMD stock, right, $5,353, if I was going to sell all that to try and get the money, the government would be able to take a 30% cut on my gains, which is once again why I say the Roth IRA is beautiful, because you can do whatever you want in there and never have to pay those gains in taxes, right? With a brokerage account, you do have to pay taxes on gains. So there is a law, I believe, that says that up to $50,000 of income you do not have to pay taxes on. But if you're older and you do want, say, 80, 90K, you will be paying taxes, right, based on what your annual income is for the year. But because the Roth IRA is limited and you can access the brokerage account without penalty at any point, it is important to have both accounts. But you want to prioritize the Roth IRA and then start putting money into the brokerage account. And if you're like me, who's building up both, then in that case, I have enough money in my Roth IRA where I feel comfortable retiring on that, right? So because of that, after I finish maxing out the Roth for the year, I am going to just switch to the brokerage account from here on out, because I don't have to worry about after 59 anymore due to the Roth being enough to compound itself there on its own. So from now on, the brokerage account is going to be the priority. So next we're going to get into, I'm stupid, so show me how to do this, right? So what we're going to do is, we're going to go into an incognito tab, and we're going to look up Robinhood, right? So this is what you would do, or you could just click on the link that I provided, but you would click on Robinhood right here, right? And then from here, you could hit login, right? And then from here, you could put create an account, and then from there on, you could go, right? So that helps get you started. So once you have your Robinhood account, what do you do? So it would open up like this. Give it a moment. It opened up looking like this, right? It'd say individual. So you're going to want to click retirement up here to create that Roth IRA within Robinhood so you can start receiving that match, right? And keep in mind, there is a limit. You can only put $7,500 into that each year, but the rest you can just put into a taxable brokerage, as I said. So then this opens up, right? So let's say you start putting in money, right here. It will show up as your buying power, right? This is how much money I have in here to buy with, right? And then these are all the stocks I own, and these are the gains I have on those stocks as of right now, right? As you can see, performance is pretty good. Started this off with like 300-ish bucks in March. We're up 31% in like 2 months. Pretty good. But that's just the power of investing right there. So now you know how to make a Robinhood account, and next we'll get into Fidelity. It's kind of the same thing. You just look up Fidelity, you hit login, right? You hit create account, it'll make an account for you, and then you'll be in the UI, which is going to look like this, right? You're going to be in the UI. It's going to look something like this, right? So where do you go from here? How do you buy stocks? So now we need to figure out, right, now that you have a brokerage, what stocks to buy, right? That's really important because you don't want to lose your money. So think of investing as risk, but also reward. You want to understand that whatever you invest into should be diversified. For most people that don't understand the stock market and spend hours and hours each week going over reports, earnings, filings, presentations, you should have 80% of your money in an ETF. Now, what is an ETF? Think of an ETF as a giant pie, right? This is QQQ. It's the tech ETF. And that ETF is invested into a bunch of different companies. So when you buy QQQ, which is this tech S&P ETF, you are buying a little bit of each and every company. You are buying a pie, right? And there's a bunch of different slices of different types of pies within that pie that you buy. So you're buying a lot of diversity. So if one company tanks or one company blows up, your account doesn't blow up because you're diversified, right? So now that we've explained what an ETF is, and like I said, you want 80% of your money in an ETF, we need to understand which ETFs are the best. So a lot of people say to invest in QQQ, the NASDAQ or the tech ETF, and I personally think that that's a great idea. But the problem with investing in QQQ is that there's simply a much better option, and that would be QQQM, which is what I've highlighted right here. When you invest into an ETF, someone else is managing that fund. So you have to pay them a small fee, I think it is each year, but you pay them a small fee to handle that fund, and that's called an asset manager fee. QQQM has the lowest asset manager fee, despite having the same holdings as QQQ, this one up here, right? So you would rather have your money in QQQM versus the traditional QQQ because it has a lower fee. So over time, you're gonna have more money compounding. And let's take a look at that real quick. QQQ, we'll look at that. So look at the 5-year performance is 118.26. We'll look at QQQM. 5-year performance, 118.65. So very similar performance, right? But this QQQ is a little bit lower because with QQQM, they have a lower fee, right? So although you will make something very similar, you will have more money if you invest in QQQM. So I would have this, if you're younger, be the main weighted ETF. You want to have a lot of your money in QQQM because it simply performs very good. If you look at the last year, it's up 40%. Just since January, it's up 18.86%. If you look in the last 6 months, we're up 18%, right? It's so good for people that are younger. I would really prioritize this. Next is VIXUS, VXUS, right? What VXUS is, it gives you international exposure. It's comprised of a lot of companies, and they're all outside of the US. Because if you think of most of the largest tech stocks, they're mostly US companies. So you want to have exposure to other countries, especially since there's a lot of growth and innovation happening there. So you don't want to be excluded from those gains. So having maybe 5 to 10% in VIXUS is not a bad idea. Next, I'm going to go over SCHD and SCHG. SCHD is a dividend fund, meaning it has companies that are more mature and they grow their dividends, which are payments that you receive as being the shareholder. Now, dividends can be good, but they are taxable, right? Because they're considered income. So if we look at, for example, Cake stock, right? Cake has a dividend of 1.87% right here. So they will pay me 1.87% of the share price, throughout the year. And the dividend payment I receive will be taxed by the government unless it's in a Roth IRA, which is once again why Roth IRAs are so superior. So I don't like companies that pay dividends as much because although they are a sign of the company producing cash, it does mean that I have to be taxed on that. So there are other companies, for example, if we go right here, AMD stock, we can look. AMD doesn't have a dividend, but over the last year to date, it's up 125.93%. So whether a company has a dividend or not isn't really that big of a deal because your share will simply appreciate more if there is no dividend, right? Because the company would usually use that money to buy back their shares off the market, which they would do instead of giving you a dividend, so you wouldn't be taxed, right? Dividends mean tax. Think of it like that, but that's okay in some ways. If you have SCHD in a retirement account like a Roth IRA, that's great because that means that those dividends that you receive can just be reinvested without you having to pay any tax. And actually, SCHD does very well. We go right here. What is the 10-year performance of SCHD with dividends reinvested? we can see that the 10-year has generated an average return of 12.5 to 13.5%. That's quite good, especially when people say that the S&P only returns 10%. So if you're able to get a higher number like that, that's great. And if you want to go here and change that, let's say you're an SCHD, right? That number, just that extra 3%, will change your 750K to $2 million. That is why I invest in single stocks, because any percent you can beat the market will exponentially increase your gains. Lastly, to get into SCHG, this is high growth, high quality companies. So I would have some amount of your money parked into SCHG as well. The ones I've highlighted are what I believe to be the best ETFs available right now. VU is also fine. It's an S&P ETF, but I just believe SCHG to be superior because of their company, because of the managers that run the ETF, and on top of that, rebalancing. They will rebalance the ETF and get rid of losers and keep the winners. So that kind of shows my reasoning regarding that. And if we go here, just to see how well SCHG performs, SCHG has had an average return of 16 to 19% over the last 10 years, right? So if we go on the low end of that, 16, I mean, look at that change, right? So I want to be in SCHG over VU just because I want that higher return and I like the fact that it's actively managed. So 80% of your money needs to go here, right? So now how do you buy that? You go to your brokerage, you put the name of the ticker, which is this, right? These letters right here, that's how you identify the ETF. So let's look for QQQM. So you go to Robinhood, you type QQQM, like that. And boom, now it opens up this screen, right? So you can check, I usually hit year to date just to see how it's been doing. So this is up 17% just since the beginning of January, right? So you see right here where it says buy. So you hit buy order right there, you buy in dollars, you put the amount of dollars you want. Let's just say I want to buy $5, right? So I hit review order, then I'll hit buy. Your market order to buy $5 of QQQM is complete. So when you do a market order, it buys it as close to this price as possible, right? So my average is $300.35, which is the average price I purchased it at, and I own $5 of QQQM. Done. Boom. Right? So then here you can track your return. You can see today's return, your total return, and you can see how much of your portfolio is this purchase. This is 1.95% of this account that I happen to own, right? Now let's say that you want to sell, right? You don't want this anymore. It's time to move on. You can hit sell QQQM, sell order dollars. You can sell as much as you want. I don't want to own this anymore, so I'm going to hit sell all, sell $5 of it. Boom. We're done. And then I got that $5 back in my account, right? I'm back to 195 of buying power. So that's how you buy and sell an ETF. Let's do that one more time we'll go SCHG. Look up SCHG. Since the beginning of the year, it's done 5%, right? But once again, I know this is worse than QQQM, but you want to look at the broader, you want to zoom out, right? Over 5 years, we've done 103%. This ETF is doing just fine. So you hit buy order. Here, you want to change it to dollars, right? Not shares. You always want to buy in dollars for the most part, so you can control exactly how much you're spending. So you would just put $5 in here, hit review order, right? And then you would hit buy, and then you bought it. But I don't want to buy that, so I'm just going to close out of that. So that's how you buy ETFs. And as I showed you earlier, you can see, let's go back here for a second. You can see position sizing of your portfolio. So if I go right here and click on FICO, which is a stock that I own, FICO is about 9.8% of my portfolio. So if you want something to be more of your portfolio, you buy more of it, or you sell it if it becomes too much of your portfolio, right? As I've shown you up here. And your stock could gain value to become more of your portfolio. This stock is up 30% since I bought it in March and April, right? And so it's increased its share in my portfolio size because the value of this position has gone up. Next, we're going to get into cash. I believe you should always have at least a 5% cash position. It's really important to have cash so that you can buy when the market goes down. You don't always want to be buying at all-time highs, right? When the market corrects, you want to be in there with cash, and you're not going to have that if you have a 0% cash position. If we go right here and we go to, let's go to retirement, and let's go to investing. As you can see, I have a 9.7% cash position. That's a lot more than a lot of people. I have that for a certain reason, but I have around $2,000 just in cash in case the market corrects. You don't want all your money to be there, right? I got $90,000, 90% in stocks, but you want cash because when the market goes down, you want to be able to buy. And let me explain this as well. If you look at QQQM and we go year to date, so this is since January, you can see in January the market was quite flat, but then we started trending downhill, right? And we were down 8% at one point from, between March 10th and March 30th. So if you have the cash and you're able to buy, then look at the rebound, right? Let's say you bought on March 30th, which I did buy on that day. You'd be up 31%, right? That's huge. But you can't do that if you're broke. So you always got to have cash, at least 5%. Think of it like this too, right? Because we can't time the market per se. But let's say you're at the top of the stairs, which is where we are right now. The market is at all-time highs. It's never been as high as it is right now. If you look at the 1 year zoom out, right? There's never been a point where we have been at $300.40. We're at the top of the stairs. As the market goes down, right? As we correct, every time the market goes down by a couple percent, you want to put more of your cash in. You keep buying as we go down, and then eventually, we'll either hit a recession and then you want to unload all your cash, or we'll start going back up and then you keep buying on the way back up. And I'll show that right here, right? So as the market went down, I continued to buy all the way down, right? And then when the market went up, I bought all the way up till about right here. And I'm pretty happy with my positions because I've done a lot of buying in this area, right? But I have the cash to do that. So I'm able to make money on the way down and make money on the way up. So that's what I mean with the stairwell theory, where when the market goes down, don't freak out, don't sell out, just keep buying a little bit as it goes down. And going back to this chart once more, right? This happened because of the Iran war. That's what led to this decline right here. A lot of people were saying you were going to go into a recession. A lot of people were saying you were going to have a total market crash rather than like a correction, right? And I don't know that, and you don't know that. None of us know that. But what we do know is that the market's going down and it's time to buy. When the market goes up, you got to ride that wave up as well. So this could have gone down another 10, 20% from all-time highs, because if we check right here, right, we went peak to trough almost 12% down, right? So imagine this went another 20% down. I would have kept buying, but I would have bought up here and I would have bought all the way down because I don't know when the worst day in the market's going to be. And that worst day ended up being Monday, March 30th, 2026. That was the lowest point in the, you could say, I guess, correction that we had, right? When we were 11.85% down from the all-time high, right? This was the worst day. And I had also bought on that day, and I bought on this day and all these days, right? And then all these days too. So that's kind of how you want to approach it. Keep that cash there so you can buy. The next thing we're going to get into is my secret sauce, which is the Mag 7 recycling bin. These companies right here are known as the Mag 7. They're considered, some of the best companies in the world, even though we can go ahead and do this. Because Tesla is trash. In my opinion, it's one of the worst companies on the planet. It's incredibly overvalued. So we should just really be changing this to the Mag 6, maybe 7. Because the Mag 6 is really the truth, right? Tesla's trash. So look at these companies, right? I've highlighted 3 companies because they're right now what you would consider to be the cheaper companies. How do you determine if a company is cheap? You want to look at something that's called the forward PE, which is forward price to earnings, which means what are we paying for the company's growth? Since these are the best companies, or considered to be some of the best companies, you know that these companies are really high quality, right? So if a high quality company goes on sale, you want to buy it, right? So as I said, 80% of your money should be in these ETFs, and then with the remaining 20% of your money, you can go ahead and buy individual stocks, like for example the Mag 6.5. So how do I decide if a stock is cheap? So I have this platform I use. It's called Fiscal AI. I'll link it. I don't pay for it. I just use it for free because there's a free option, and honestly, you don't need to pay for it either. So on this platform, let's type in Meta, right? So I type Meta, and then I click financials right here, and then there's a search bar, and you can look at PE, right, which is price to earnings. So I always do forward PE. Remember, there's a lot more that goes into this. This is just kind of an example of something that you can look at to see when you're looking at the Mag 7 if you want to have a couple of single stocks and have higher gains. Right here, I scroll down and I hit this gear button and I hit toggle median line. So right here, you can see the median, which is 22.21. It says it right here, right? So this means that this stock has traditionally traded at 22 price to earnings, which means people were willing to pay this value at this line for this stock on average. Right now, we're trading at 18.59, which means we are trading below what people would normally pay. If I give a car example, that means that imagine people are willing to pay $30,000 for a Toyota Corolla, right? That's the average price. Right now, you're able to buy a Toyota Corolla for 25K or 20K. Obviously, you're going to buy that and then sell it when it gets back to the average price, right? And you can see there are times where it's overvalued. At some points, Meta traded at a forward PE of 30, right? So it traded up here. People were willing to overpay for it, right? You just want to buy companies that are high quality and are below the median line, so it means you're getting a deal, right? And let's explain that too. Let me show you that. In January 2023, Meta was trading at a forward PE of 12.7, right? 12.7. Now let's go here. Stock price change. This is how you're going to be able to make a fuckload of money, right? Meta was trading down here at 12.2, right? You could have bought in right here at this low price, right? And boom, rode this profit up. Meta stock went up almost 200%. Whenever you buy down low, the stock goes up if it's high quality, right? For the most part, right? If you bought right here, the stock had a chance where the PE went up to 29 and you could have sold it for a really good deal. Same when it comes down here, you could have sold it for a good deal. Can't comes down here, right? And I bought down here as well. It's up to here, but I'm not going to sell until we get above this median line, right? Because this is the average price. Even if I can make a profit, I'm not willing to sell for below what I believe to be market value. And we'll explain that in the stock too, right? So I said January 23 was a great time to buy. Let's look at the 5 year. January of 23, right here. If you held this stock for 1 year, you would have made a 171% return. Boom, right? This is really not hard to outperform the market if you're not a fucking dumbass. So all you have to do is buy shit on sale. Look at the forward PE being below the median line, like it was right here in where was it real quick? December of 2023, right here. You buy below the line and you sell above the line. Boom, easy, right? And the lower you are below the line, the better it is for you because that means you're getting a bigger of a deal. But remember, this only works for high quality companies, which is why in the slideshow for beginners, I limited the secret sauce to just these high level companies, right? You just want to use these companies. And I'll give you another example. Let's look at let's go ahead and look at Google, just because I want you to understand how easy this is to really do. So we're gonna look at Google. We're gonna go to the overview. You can see right now Google trades at $382 per share. We'll go to the financials. We'll look forward PE. Boom, right? We got this shit pulled up. Right now would be a great time to sell Google. As you can see, the PE is really freaking high, but you can hit toggle median line, right? And you can see that the median PE is 21.43. So people have traditionally been willing to pay around 21.43 of this forward PE metric for Google. And what I'm going to do is I'm going to reduce this time period like this. The reason why I'm doing that is because back here, Google was in a growth phase. Google was growing a lot more. It's still growing a lot, but the more mature a company is, usually you're willing to pay a higher PE for it because it's more reliable. You know, it's been around longer. For example, we'll go right here. Costco PE. Look, Costco's PE is 53, right? It's just been around forever and it's going nowhere, right? So it took a while for Google to establish that reputation. Anyways, right here you can see the median PE forward wise is 21. You could have bought Google down here, and this chart updates real time, so you can always just be looking at companies on your watch list and know this. Look at this, 15 PE right here, 15 forward PE in May of 2025. Let's go here. Google stock, 1 year. Let's go to May of 2025. We got August, we got June. We got to go to the 5 year for this. So we'll go to April, May, right? Let's look at what happens if you bought Google on sale. Wow, a 148% return. All you gotta do is just look at the 4 PE. It takes 2 fucking seconds. Just as long as this number is significantly below the median and you buy down here and it's a good company, when it gets over the line, then boom, you know, that's a lot of money. And the thing is, you could always say, okay, well, how do you know to sell at the line, right? Because you can see right here, the stock went way above the line. So if you sold up here, you could have made a lot more money, right? And at some point, you could be greedy. You could say, okay, you know what? Now that Google's hit the line, I'm gonna hold on and hope it goes up more, and then I'll sell it up here for big profit, right? But the other thing you could say is, well, you don't know that. What if it goes down? So what if I only sell at the line? So you buy here, May of 2025, and then you sell when it hits the line, September of 2025. Let's see what happens right there, right? So we're gonna go May, and then we're gonna go to September, October, September, right? So literally, January, February, March, April, May, June, July, August, September. In 5 months, you can make a 56% return, right? So you don't have to just sit here and wait for it to go above the line. You can just wait till we hit the average and sell out and make your money, right? So all I'm trying to say is this is the method. Pick the highest quality companies and buy them cheap. And right now, one that I'm doing is right here. Let me find it. MasterCard. This is a banger company. And if you want to look at forward PE, this is one of the best times to buy this company. Look at this, right? If we hit access controls, we go to toggle median, right? The average for MasterCard, and let's shrink that a little bit, right? The average for MasterCard here showing is 32. Look at this. It's down to 24. Whenever this goes back up and hits this line, because it inevitably will, since MasterCard is a great fucking company, you are going to make so much money. And this concept is called re-rating of multiples. In the past, the average people were willing to pay is a 33 forward PE. Right now, it's down to 24. And eventually, when it gets back to being fair value, you sell out, you make cash. So that's the secret sauce. I know this video is getting really long. You just look at the top couple companies and recycle them and sell the ones that are trading expensive, like Google right now. The PE is way above the median of 21. It's at like a 30 something. You sell out and you buy the cheap ones like Meta that are way below, right? That's just what you do. Now, my final thing of secret sauce that I have is the VIX. If you can understand the VIX, you will make so much money, right? You only really need to know 2 things. The VIX monitors fear. The more scared people are, the higher the VIX number. A high VIX number means the stocks are on sale, right? And let me explain this to you too. If we go and hit VIX index, look up VIX index and go to a 5 year, right? Every time the VIX spikes high, right, enough to where it differentiates itself from everywhere from the other spikes, like right here, things were high, right? That's the best time to buy. The VIX right here, it spikes to 45, right? And the average VIX is much lower. So seeing that everyone's eyes can see this giant spike. This spike happened on April 4th. Let's say you bought right here, March 28th, right? Even just seeing that the VIX was going higher up here, you were like, all right, I'm going to buy up here, right? Let's say you didn't even buy on the high spiking day. So you bought, you bought right here, March 7th. So let's go here and look at the S&P. BOO. So where you will go back to the 5 year. Let's say 2025, March 7th, which is going to be right, can I get it? right here, right? Boom. From here, you have a 30% return, right? Because you're buying in the downturn. And let's look at the big VIX spike. The VIX spiked right here at 45, right? What day was this? It spiked to 45 on April 4th. So if I go to April 4th, that is the day in the market where the market was the most down. So if you buy when the VIX spikes, look, your return would be 48%, right? And that's in 1 year. You could have made 48%. All you got to do is buy when the VIX is high. Buy when the VIX is high. It's really easy. Right here, we have the Iran war. The VIX spiked up, right? We'll go year to date. Look at that. VIX spiked up to 31. I bought like a madman. I was thinking about selling feed picks to buy more. Like, this is how bad you need to be buying. When the VIX goes up, you buy, right? If the VIX is over 30, do whatever you got to do. Sell your family to buy more of, QQQQ or whatever stocks. Just buy more, right? And then the VIX came down, meaning the market went up. So what happened here on March 27th when the VIX hit 31, right? Let's look at boom. So year to date, on March 30th or 31st, boom. If you invested then, you'd be at 15% in 2 months. Huge. You get to ride those rallies up, right? And I don't like VU. I like QQQM the most, as I said. So if you invested on the worst day, which is March 30th, where the VIX spiked, you would have a 30.7% return in 2 months. Boom, right? So what I'm trying to say is, if you understand the VIX, or when the VIX goes high, that's when you buy, you will make infinity money, okay? You just gotta hold on. When the VIX goes over 30, sell your house, sell your family, sell your girlfriend, do whatever you gotta do, open an OnlyFans, and buy the stock market, okay? If you buy QQQ, that'd be the best, because tech has higher growth. But even if you bought the regular S&P, you saw it, you're still going up 15%, man. And that's how the returns happen. If I go to my portfolio right here, you can look year to date, right? It was flat because of the Iran war. And then as soon as, I started buying in here, as the VIX went down, right? Because when the VIX is down, stuff's getting more expensive, people aren't scared anymore. Boom, we just exploded. Like, look at this. My returns since January, 27.67%, and the S&P's only done 10, because you really can time your buys by looking at the VIX, because when people are scared, that's when they're selling out, they're being pussies. So basically, this is the guide to investing. I explain why you invest, use these platforms, open 2 accounts, then 80% of your money should be going into these highlights. Most of your money should be in this QQQM. Keep a 5% cash position. Look at these stocks with your remaining 20%. Use the forward PE that I showed you how to do right here. You just click it on the fiscal AI, put a name in, click forward PE, click this gear line, it'll open the median, hit toggle median line, right? You want to toggle median, not average, right? Toggle median. Median is 31. Look at the high quality companies that are below this. If they're below by a decent amount, it's usually a great time to buy, right? So you only want to have 20% of your money doing that, right? The rest you want to keep in the index just to keep it safe. So, and then look at the VIX. Obviously, when the VIX spikes, that's when you go buy. So this is my idiot's investing guide. If you have no idea how to invest, watch this.